The OECD defines impact investment as the provision of social finance to organizations that address a social or environmental challenge. Now, there is a number of definitions out there in the market, and the OECD back in 2015 had also proposed a number of characteristics and attributes that can help define the perimeter of impact investing. And these include, for instance, the fact that beneficiaries should be populations at risk by social, demographic, revenue or territorial indicators, that the investors and the delivery organization should have some intent or commitment to report on the results, both financial and of the social and environmental outcomes, and that the return expectations should be at market level or below. So of course, the investment dimension implies some sort of financial return, but this should be assessed side by side with the risks involved in the investment and of course the social and environmental expectations. So what is defining in impact investing is really these three dimensions that describe the intentionality of the investment: the return, the financial, the risk, and the social and environmental measurable outcomes that are expected by the investor. The literature shows that actually impact investors are mostly looking for market level returns. So very few impact investors target below rate financial returns. This, when it is the case, this is often accompanied by some sort of concessional element, which could be, for example, a technical assistance facility. Side by side with that, impact investors are obviously looking for expected measurable social outcomes or environmental outcomes. Very few of them, according to the OECD data, very few of them also tracked indicators that describe the governance issues. So for instance, the participation of women in the decision-making process. Environmental outcomes are in general more easier to track because they're more standardized, whereas in the social sphere, this is still very, very difficult and open to debate. In particular, what we see is that impact investors track and report on outcome level indicators, output and outcome level indicators, but of course, because impacts takes a longer time, delay in time to manifest themselves, they are often they cannot be observed at the end of the investment. So typically when an investor will pull out and will retrieve the loan, for instance, impact will not be observable yet. And to assess the actual impact, there needs to be the involvement very often of a public authority that will provide concessional funding for ex post evaluations, for instance. The OECD has tried to map worldwide initiatives to promote impact investing as promoted by domestic national policymakers. We have identified over 590 policy initiatives that can be categorized in different areas. So from setting the rules of the market, the financial market in particular, but not only, informing citizens about opportunities and how to go about impact measurement, producing finance, so supplying additional capital for the impact investing market. All of these are described as existing policy instruments that policymaker can adopt at the domestic level or in the development cooperation sphere. However, because impact investing is such a recent field, we have only about 20 years of public policy evidence, and it's quite nascent still. So while some countries have a long tradition of public administration's involvement in this market, others do not. And it's yet too soon to have a complete and exhaustive list of the potential instruments to foster impact investing. One thing that the OECD report stresses is that it's very important also for policymakers to have a full diagnosis of the market before entering the policymaking cycle and selecting which pillars of the market they want to address and through which instruments. So policymakers should always consider the enabling environment at large in terms of financial market regulation, for instance, but also ease of doing business, identify the exact social and or environmental problems that they want to tackle, and then look at the three pillars of the market, so both the supply, the demand, and the intermediaries, which play a fundamental role both in terms of capacity building and in terms of channeling finance to actual mission-oriented enterprises. Intermediaries are very important, and there's still a lack thereof. So one thing that is coming about is that stock exchanges are increasingly turning towards adopting social criteria for the companies and the equity listings that they have. This has been heavily promoted also by the United Nations. There have been more and more intermediaries that are born out of legislation for unclaimed capital assets, for instance in the UK and more recently in Japan. So these are all wholesaler or retailers of social equity, for instance. But it's still, their task is very, very difficult both in matching international capital supply and local social enterprises or mission-oriented businesses. Then there's a number of intermediaries that are emerging and that play that fundamental role of actually supporting the business design and the development of the business concept and the theory of change, whether they are named as incubators or accelerators. And these there are more and more of, usually often supplied by public entities, whether they are at the local or at the national level. And they are increasingly emerging also in developing economies or emerging frontier markets. But indeed, they play a fundamental role, and if we want impact investing to reach scale, it's important for public policymakers to support the creation and the activity of financial and capacity building intermediaries.
So venture philanthropy is very different from both traditional philanthropy and traditional investment. Venture philanthropy is a high engagement and long-term approach in order to support NGOs, social purpose organizations and social enterprises that are willing to create and bring new and innovative solutions to pressing social issues. Venture philanthropy comes with both financial and non-financial support, and it puts a clear focus on impact measurement and management. So investors that adopt the venture philanthropy approach are called investors for impact. The venture philanthropy, and what do these investors for impact provide? So first of all, they provide investment, either in form of grants, debt, equity, or other form of hybrid financial instruments that are matched with the needs of the social enterprises, the underlying social enterprises. On top of that, alongside the financial support, they provide a wide range of non-financial services which are aimed at strengthening the capacity of the social enterprise to deliver its social impact. For example, by supporting them with the developing of their business model, or in professionalizing their team, or providing marketing and legal advice. On top of that, Investors for Impact are committed in measuring their impact of their activities and also to manage the data collected in order to maximize the social impact and minimize the negative one. So traditional philanthropy, on the other hand, is quite different because it is usually related to grant-making activities with a short-term time horizon. So obviously, investors for impact, venture philanthropists have the realization of the social impact at the core of their business strategy, and of course this reflects in the characteristics of the social enterprises they are looking for. So typical investors for impact invest in early stage social enterprises that have the potential to develop new and innovative way to solve pressing social challenges. And it's important here to stress the fact that Investors for Impact enter the market at a stage in which the risk is so high and the lack of track records would deter any other investors to enter, thus filling a widely acknowledged gap in the social investment space that is referred to with the name of Valley of Death. On top of that, I would like to stress again the importance of the innovativeness of the business model and of the solution. So venture philanthropists, as traditional venture capitalists, do not put the accent on the financial viability in the short term or on the financial returns, but they're really willing to bet, to take the risk in the very early stages if they believe in the potential of this social enterprise to bring into the market disruptive business models. On top of that, obviously, Investors for Impact look for other dimensions in the social enterprises. For example, the capacity and the capability of the team to deliver the activities they should deliver, but also at the capability and at the potential to develop a business model. And finally, I would like also to mention that venture philanthropists do not just provide capital to early investors, so to early stage ventures, but also provide growth and expansion capital during the scaling phase of the business. The early adopters, let's say, of venture philanthropy were mainly two organizations. So on one side there were foundations that were finding new ways of being more engaged with their grantees, and on the other side you had social impact funds, which were founded by traditional venture capitalists that looked at a new and innovative way of solving social challenges, applying the principle of venture capital. Their strategy may differ alongside different dimensions. For example, the financial instruments used. For example, foundations usually deploy financial support through grants and debt, while social impact funds are more relying on equity, typically. And obviously their strategies can differ alongside different dimensions. For example, the type of the social entrepreneurs and social purpose organization that is supported, or the geography is targeted as well, because we have Investors for Impact that target different geographies and different world areas. And finally, also the categories of the final beneficiaries that they would like to have the final impact on. Let me also mention the fact that this space is evolving. So since when we were founded 15 years ago, the space has evolved and new actors adopted the venture philanthropy approach. And among others, I would like to mention corporate social investors, which are basically investors for impact that are adopting the venture philanthropy approach and are linked to a corporate so that they can leverage the resources of the corporate at some extent. And on the other side, there are banks which have developed a wide variety of strategies around impact, and some of them are using the venture philanthropy tools. So we classify them as part of our space. And looking at the future, we also see other actors that will come and join the space. And us as EVPA, as the community of Investors for Impact, we look forward to help and supporting them to maximize their social impact.
Crowdfunding belongs to what is called FinTech. So this is the application of new technologies to financial instruments. In particular, crowdfunding is a form of alternative finance, so a way to channel resources outside the traditional banking system. And crowdfunding started in 2006 during the period of financial crisis. And in principle, it entails the collection of small amounts of money from many people towards a cause. So there are 4 types of crowdfunding, and the 4 types link in principle to the type of reward that people expect in return for donating their money. So the first type of crowdfunding is donation crowdfunding. In this case, there is no expectation in terms of getting back something. Then the second type is reward crowdfunding. And under reward crowdfunding, the donor expects some form of non-financial reward. It can be a small gift, a prototype of a product, or a token gesture. And then there is loan crowdfunding. In this case, the expectation is to receive back some form of interest, while under equity crowdfunding, the expectation is to obtain a stake inside of an investment. What is notable is that all these types of crowdfunding are performed by platforms. Platforms are, in substance, aggregators, so they connect fundraisers to funders, and to do so, they connect and mobilize different assets, people, stakeholders to create a transaction and extract value from the transaction. There are, in principle, 3 things that make a crowdfunding campaign successful. Firstly, strong marketing. Second, tapping into social media. And third, tapping into wide social networks. Our study, however, went further into the analysis of a successful crowdfunding platform to understand how crowdfunding and the SDGs could be brought together to create an impact. And we found out that when crowdfunding and the SDGs are put together, they can create a strong impact towards the SDGs. And there are three key takeaways from our analysis to make a successful use of crowdfunding towards the SDGs. So the first takeaway is that you need a successful platform that works like incumbent platforms. The second is that you need a strategy. And the third is that you need system builders. So these are people that stay behind the platform. The provocation that I want to give here is that social entrepreneurs have all the tools and technology available to create their own crowdfunding platform and deliver impact. And I want to give you a few insights into how you can better create as a social entrepreneur your own crowdfunding platform for impact. Firstly, you should use the technology that is a dominant design technology, and you can access this type of crowdfunding technology using white labeled solutions that will cost you approximately $50 per month. You can leverage on social media to better connect with donors using these campaigns and make a crowdfunding process very transparent by connecting the crowdfunding campaign to public database and networks of social enterprises. The second takeaway that I want to give you is that you need to connect basically two parties to create a successful platform, and you need to be very, very clear on your strategy. On one side, you want to connect networks of social entrepreneurs or social innovators, potentially wide networks, because this will give scale to the platform very rapidly. On the other hand, you will connect the projects to different types of donors. You can connect them to people that are in your first level network using social media, but you can also target corporates that are willing to advance corporate social responsibility agendas through the crowdfunding platform. And thirdly, you can connect also to local authorities and governments who have an incentive to use crowdfunding to advance the policy agenda. The important thing is that the platform enables the funding of projects that have a measurable impact towards the SDG. They are able to measure outputs aligned to the indicators, result, and eventually one day track impact. And the third takeaway that I want to give you is that you, as a social entrepreneur behind the platform, you play a key role as system builders. Your role will be to connect parties and mobilize networks and technology and to craft the strategy of your platform, and bring all the parties together so that they can build successful campaigns that then can report on output and results towards authorities, towards your donors, and towards creating better campaigns for fundraisers.